All right, it's Tuesday, April 1st, 2026, and the market is pretty much holding its breath for two absolutely critical reports. We're talking about the ADP employment change and the ISM manufacturing PMI. These numbers could really be the trigger for some major moves across all assets, and we're here to break down exactly what you need to be watching for. So let's get right into it. All eyes are on these two reports. So the big question for every trader and investor today is pretty simple. Are you ready for the potential fireworks? Because these numbers, they have the power to shift the entire market narrative in just a heartbeat. So these are today's main events, the ADP employment report and the ISM manufacturing index. You can think of them as a real-time health check on the U.S. labor market and its industrial core. We call them red events for a reason. They have the highest potential to create market-moving surprises, and a miss in either direction is going to send ripples across the entire board. So before that data actually drops, let's take a quick look at how the board is set. Here's a quick rundown of where key assets are positioned right now heading into these massive releases. First up, the S&P 500. It's holding pretty firm at 6,528. The market's shown some remarkable resilience lately, really finding a solid footing. But don't let that fool you. The sensitivity here is high. Make no mistake. Despite all this strength, the current risk-on mood, where investors are comfortable buying riskier assets like stocks, well, that could evaporate in an instant. A surprise in either the ADP or ISM report could trigger a very, very rapid repositioning out of equities. Hopping over to the energy markets, Brent oil is sitting around $101 a barrel. It's moderated a bit from its recent highs, which has taken a little of the edge off of inflation pressures. But energy is still a central piece of this macro story. And its sensitivity is also high, especially to that ISM report. There is a really sharp, direct link here. If that manufacturing number signals a contraction, meaning factories are slowing down, it implies they're using less energy. Oil demand expectations will weaken almost immediately. That is the key risk for oil today. Meanwhile, gold is telling a completely different story, priced strong at $47.56. What this tells us is there's some significant safe haven demand bubbling just under the surface, as investors look for a hedge against inflation and, well, any other risks out there. Right, so gold is basically playing defense here. While its sensitivity is maybe medium compared to oil or stocks, any data surprise today could really accelerate those defensive flows. It could tilt the market's entire risk balance as investors rush for safety. And rounding out our landscape, we've got Bitcoin, holding steady around that $68,000 mark. For now, liquidity seems stable, and its resilience has really supported that cautious risk-on sentiment in the broader market.
But just like equities, it remains highly sensitive to macro events. A sharp risk-off move triggered by today's data could easily lead to a rapid pullback, and all eyes are on that critical $65,000 support level. A break there could signal that broader risk appetite is fading, and fast.
Okay, so we've seen what the market looks like. Now let's connect the dots and get into the why. Why this data has such a powerful effect on everything. It all comes down to a really clear transmission chain. Check this out. This is the transmission chain. It starts with the data release. The very first thing to react is usually the US dollar index, or DXY. From there, that reaction causes bond yields to shift. And finally, risk assets. We're talking stocks, crypto, commodities. They respond to those changes in the dollar and yields. It's a pretty clear four-step chain reaction. Now, let's zoom in on a really critical piece of this puzzle. The DXY is currently at 99. What does that mean? Well, it signals softer pressure on the US dollar. And this is hugely important because it acts like an amplifier. It basically creates the conditions for bigger, more dramatic swings in other assets when a surprise hits. To put it simply, and this is really the key takeaway here, because of where the dollar is, any surprises in the ADP or ISM reports today are going to have an amplified effect on bond yields and all those risk assets we just talked about. The stage is set for a potentially oversized reaction. So, how could this all actually play out? We've gone ahead and mapped out three distinct scenarios for how the day could unfold, all based on what this data shows us. Scenario A, our most probable outcome, is what we're calling controlled stabilization. This is what happens if both ADP and ISM come in right around what everyone expects. The result? Minimal market disruption. The S&P would likely hold its current range, the VIX, the market's fear gauge, would stay stable, and Bitcoin would just hang out in its current channel. A pretty calm, orderly day. Then there's Scenario B, the plausible surprise. This is economic heat. This happens if the data comes in hotter than expected. A strong ADP or ISM report signals inflation and puts upward pressure on bond yields. In this case, we'd probably see the S&P dip, volatility rise a bit, and a slight pickup in those defensive flows into gold and Bitcoin. And finally, scenario C. This is the low probability but high impact major shock. This would get triggered by a huge miss in either report, way above or way below what anyone's thinking. This would spark a true risk-off rotation. You'd see the S&P fall sharply, the VIX would jump above 30, and you'd likely see gold surge toward $4,800 as investors just run for cover. So, with those scenarios in mind, let's distill all of this down into the most critical price levels and takeaways that you should absolutely be watching for today. Here are the key levels for your dashboard today. Brent oil pushing past 105, that signals renewed inflation pressure. A VIX over 26 means volatility is heating up. The S&P dipping below 6,500 indicates some real equity stress. Gold popping above 4,780, that's your safe haven alert. Bitcoin dropping below 67,000 suggests risk appetite is fading. And finally, if the DXY breaks above 100, that signals a tightening dollar. Keep these levels on your screen. And this brings us to the final crucial question of the day. We've seen the market's resilience for sure, but now it's facing a big dose of reality from these two reports. So the question to leave you with is this: will today's data confirm the market's underlying strength, or will it expose a weakness that has been lurking just beneath the surface all along? I guess we're all about to find out.